In the world of finance, noise is everywhere. Every day, experts on television scream about the next bull market, the next crypto rally, or the next tech stock that will make you a millionaire overnight. But while the world is shouting, the greatest investor in history has gone silent. Warren Buffett is not screaming. He is not hyping up the latest AI trend. He is doing something much more terrifying. He is selling. As of late 2025, Warren Buffett's company, Berkshire Hathaway, has amassed a cash stockpile of over $381 billion. Let that number sink in. That is not just rainy day money. That is more than the GDP of entire nations like Denmark or Hong Kong. It is enough money to buy Disney, frantic, in cash, and still have billions left over. For the last 4 quarters, Buffett has been a net seller of stocks. He has slashed his beloved Apple position. He has dumped billions in Bank of America shares. He is exiting the market at a pace we have not seen since the prelude to the 2008 financial crisis. Why? Buffett has famously said, "Be fearful when others are greedy." Right now, the market is greedier than it has ever been. Valuations are at historic highs. The Buffett Indicator is flashing red, and the Oracle of Omaha is quietly moving his chips off the table. He isn't holding this cash because he loves inflation. He is holding it because he sees a storm coming that the rest of us are ignoring. A storm that could wipe out 50% of your portfolio if you aren't prepared. In this video, we are going to deconstruct exactly what Warren Buffett sees. We will analyze the 3 specific indicators that have him terrified. And most importantly, we will give you the step-by-step battle plan to protect your wealth so that when the crash comes, you don't just survive, you get rich. This is not a drill. This is the warning. Chapter 1. The $381 billion signal. To understand the magnitude of what is happening right now, we have to look at the behavior of Berkshire Hathaway. For decades, Buffett has been the ultimate optimist on America. His golden rule has always been, never bet against America. He loves owning businesses. He loves collecting dividends. So, when the ultimate optimist starts hoarding cash like a doomsday prepper, you need to pay attention. Let's look at the data. In the years leading up to the 2008 Great Recession, Buffett's cash position grew significantly. He complained that there was nothing to buy. He famously sat on his hands while everyone else was flipping houses and buying subprime mortgage bonds. Then, the crash happened. And because he had the cash, he was able to swoop in and buy companies like Goldman Sachs and General Electric for pennies on the dollar, making billions in profit. Today, the situation is repeating itself, but on a scale that is mathematically unprecedented. The most shocking move came from his sale of Apple. Apple was the crown jewel of his portfolio. He called it the best business I know. Yet throughout 2024 and 2025, he sold over 50% of his stake. Why would he sell the best business? Tax reasons? Perhaps. Buffett mentioned that tax rates might go up in the future, so taking profits now makes sense. But you don't sell $100 billion worth of stock just to save a few percentage points on taxes. You sell because you believe the upside is gone and the downside is dangerous. It comes down to opportunity cost. Right now, short-term U.S. Treasury bills are paying around 5%. That This metric was developed by Nobel Prize winner Robert Shiller. Unlike a normal P/E ratio, which looks at 1 year of earnings, the Shiller PE looks at the average earnings over the last 10 years, adjusted for inflation. It smooths out the noise and tells you if the market is actually expensive. We are in the top 1% of the most expensive markets in history. The only time stocks were more expensive than they are right now was right before the dot-com crash, which resulted in the NASDAQ falling 78%. When the Shiller PE is this high, it mathematically predicts one thing: low or negative returns for the next decade. This is the trap that new investors fall into. They look at the last 5 years and think, stocks always go up. But when valuations are this stretched, the rubber band has to snap back. Think about it. If you buy a house and rent it out, you want to make your money back in 10 or 15 years. Buying the S&P 500 right now is like buying a house and taking 40 years to make your money back from rent. It's a bad deal. Then there is the Buffett Indicator, the ratio of the total stock market value to the GDP of the United States. Buffett once called this the best single measure of where valuations stand at any given moment. If the stock market is worth 100% of GDP, that is fair value. In 2000, it hit 140%. Today, it is sitting near 200%. The stock market is essentially double the size of the actual economy it represents. This is a disconnect from reality. The economy, the actual buying and selling of goods and services, cannot support these stock prices forever. Gravity always wins. Buffett knows that when this ratio reverts to the mean, and it always reverts to the mean, it happens in one of two ways. The economy grows massively, which takes decades. Stock prices collapse by 50%, which takes months. Which one do you think is more likely? Chapter 3. The economic triple threat. It isn't just that stocks are expensive. If the economy was booming, maybe we could justify high prices. But Buffett is looking at the economy and seeing cracks in the foundation. We are facing an economic triple threat. Threat number 1, the debt spiral. The U.S. national debt is spiraling out of control. The interest payments alone on the U.S. debt are now higher than the entire defense budget. This puts the Federal Reserve in a trap. If they keep interest rates high to fight inflation, the government goes bankrupt paying interest. If they lower rates to save the government, inflation comes roaring back. Buffett hates inflation. He calls it the giant tapeworm that consumes your wealth. By holding short-term treasuries, he is keeping his money liquid, ready to deploy, rather than locking it into 30-year bonds that will lose value if inflation spikes again. Threat number 2, the consumer is broke. During the pandemic, Americans saved trillions. That money fueled the stock market boom. But that savings buffer is gone. Credit card delinquencies are rising to levels not seen since 2011. Auto loan defaults are surging. The engine of the U.S. economy is the consumer. 70% of GDP is just us buying stuff. If the consumer is tapped out, corporate earnings must come down. And when earnings come down, stock prices follow. Threat number 3, geopolitical instability. Buffett reads history. He knows that wars and trade wars disrupt supply chains and spike inflation. We are living in the most geopolitically unstable time since the Cold War. In his 2024 and 2025 shareholder letters, Buffett has been subtly warning about the fragility of the global system. He has been reducing his exposure to banks. Why? Because banks are the first to fail when the global system seizes up. He sold Bank of America not because he dislikes the CEO, but because in a crisis, banks are dangerous places to be. He is retreating to the castle and pulling up the drawbridge. Chapter 4, the psychology of the crash. What happens when the storm finally breaks? Most investors today have only seen a bull market. They think a crash is when stocks single dollar into expensive stocks right now. Start building a cash position. Buffett has nearly 30% of his assets in cash equivalents. You don't need to go that extreme, but having 10 to 20% of your portfolio in cash or short-term treasuries like SKOV or BL ETFs gives you options. When the market crashes, cash is not trash. Cash is courage. If you have cash, you won't panic. You will be excited to buy cheap stocks. Step 2. Flight to quality. Look at your portfolio. Do you own speculative, unprofitable tech companies that promise to make money in 2030? Buffett is holding companies like Coca-Cola, American Express, and Chevron. Companies with real cash flow, real assets, and pricing power. If a company doesn't make a profit today, it will get slaughtered in a recession. Clean up your portfolio. If you wouldn't be happy holding the stock for 10 years if the market shut down, sell it now. Step 3. Kill the leech. Buffett hates debt. In a high-interest rate environment, debt is a portfolio killer. If you have credit card debt at 20%, paying that off is a guaranteed 20% return on your money. That is better than any stock Buffett can buy. Clear your liabilities so you can survive a job loss or an economic downturn without being forced to sell your stocks. Step 4. Make your shopping list. This is the most important step. Don't wait for the crash to decide what to buy. Make a list of great companies you love but are too expensive right now. Maybe it's Microsoft, maybe it's Costco, maybe it's Google. Write down the price you want to pay for them. When the storm comes and the news is shouting that the world is ending and those stocks hit your price, buy. Don't hesitate. Follow Buffett. Be greedy when others are fearful. The storm is coming. The clouds are gathering. The indicators are flashing red. But for the prepared investor, a storm is not a disaster. It is an opportunity. Warren Buffett has already won the game. He is sitting on the sidelines with his $381 billion, waiting for the rain. The question is, when the rain starts to fall, will you be running for